The average VC looks at a pitch deck for about 3 minutes before deciding if you're going to take a meeting. So you have to get very quick at pattern recognition. The biggest red flag is people not being aware of their indirect competitors. Oftentimes founders are like, we have 2 direct competitors. And I'm like, maybe you have 2 direct competitors, but you have about 100 indirect competitors. A lot of the times we talk about the disadvantage that women don't get funding. But what's interesting is even the women who get funding are disadvantaged. And so it's not even just that women founders aren't getting funding. Even when they get that funding, they're disadvantaged compared to male co-founders.
I mean, the truth is that the majority of investment dollars are controlled by men. Whether we like it or not, that's a reality. And I believe that if you're starting good ventures, you need to be able to access investment dollars, whether they're controlled by men or women. Maybe it's idealistic. The question is, what do we need to do as founders or even at a more holistic level or systemic level to get more mainstream investors, aka male investors, to understand the value of women-founded ventures, especially if the problem is not transparent to them? Welcome to Season 6 of the new and improved Invisible Ink podcast. I'm your host, Shubha Chakrabarti, Chief Financial Storyteller at Achieve. We have completely redesigned every aspect of this podcast from the ground up, so it can be even more valuable to you, the founder. We're kicking off the season with Angela Lee, who's our guest for today. Angela Lee is an accomplished educator and entrepreneur. She's the founder of 37 Angels, an investment network dedicated to closing the gender gap in startup investing through education. With a background in teaching at Columbia and a wide-scale presence in the media, Angela brings a wealth of knowledge and expertise in the areas of startup funding, venture capital, and strategic growth. In this conversation, she shares her insights on the latest trends in early-stage funding, challenges for women when raising funds, ways to overcome these challenges, and much more. And now, here's Angela. Hello, Angela. Thank you for being on Invisible Ink today. We're so excited to have you.
Thank you so much for having me.
So I was really impressed when I first looked you up and I learned a little bit more. You've done a lot in your life. You've been teaching at Columbia for a long time. You're the founder of 37 Angels. You've been on MSNBC, Fox, you name it. You've been on every possible channel I can think of. So I think you have 2 or 3 different perspectives you bring to the table. And what I'd like to do today is really dive into all of those lenses and see what we can learn from you in terms of founders, funding, all of that good stuff. So I want to jump right in. Just to start off, in terms of the state of early stage funding, we all know that 2022, 2023 is a very different world than 2021, 2020. So what are you seeing in terms of the early stage funding trends today, specifically with regard to women founders?
It's a big question to start off with, but in terms of what I'm seeing, I think what people are talking the most about is certainly valuation. And so what we do know is that for late stage, valuation has dropped a lot. For early stage, valuation hasn't dropped nearly as much, but unfortunately, deal flow is down across the board. So regardless of what stage, what geography, what sector, people are doing between a third and a half fewer deals than they were 2 years ago at this time.
That's a huge number. I didn't expect that number to be so big. And just given that early stage is a little bit protected from exits and all of that other stuff that happens from a market perspective, do you have any insights or thoughts on why that might be?
There are a couple of reasons why early stage hasn't seen the lower valuation. On the founder side, it's actually that founders are basically just not raising. They're saying, it's a really scary market. I'm not even going to put my foot out there. I'm going to kind of hold out and hunker down. And so, I'm an investor in about 100 plus companies. And so I get monthly, quarterly updates from them. And 2, 3, 4 years ago, people were sitting on 12 months of cash, 18 months of cash, 24 months of cash. I'm now getting emails from founders saying I'm sitting on 36 months of cash because I've just really tightened my belt. And I'm like, I do not even want to try to raise in this current environment. So I think that's a big driver. The second driver is venture capitalists are being a little bit more prudent about how they put capital to work, and people are slowing down their check writing. The deals that are getting done, I do think are of higher quality. And so that's why they're maintaining valuation. And then the other reason why we're not seeing valuation drop nearly as much is that VCs are sitting on a ton of dry powder, right? They raised a record amount of capital between 2015 and 2021. They haven't deployed all that cash yet. So VCs are able to kind of keep those companies going that raised in 2020, 2021. And then the last thing I'll say is, if you think about valuation, one of the weird things about valuation is it's all based off of future potential. It's not based off of historical performance. And for late stage companies, you have to be very realistic about the exit market. But for early stage companies, they're not going to exit for 5, 10 years. And so because their exit is so far away, it's a little bit easier to say, well, the market's going to improve by the time they go to market. And so I think that people can be more bullish in their valuations at early stage.
Which leads me to my next question. There are these ups and downs, and we've seen at least a couple of these the last couple of decades. Do you think there's a fundamental shift in terms of investors' risk appetites for startups?
It's a change in risk appetites, but what the data very clearly shows is that what is seed has gotten later and later. And so it might surprise you to know that right now, the average seed company that goes out for fundraising is 3.3 years old. I think that's a really surprising number. People think about seed companies, it's early stage, seeds are little, but that's absolutely not the case. These are companies that are, several years old. I just got off of listening to a bunch of founder pitches, and these are seed stage companies that have millions of dollars of revenue. And so what is seed today is so different than what is seed a decade ago.
And that has it changed the size of funding that they're asking for as well?
Absolutely, right? So a decade ago, raising a seed round was raising, half a million, maybe $1 million. And these days, a seed round is $1 to $5 million. There's a fun term called a mango seed because mangoes are really large seeds. And that's basically you're raising a really large seed round, which is this kind of really silly terminology that got very popular during the late teens, kind of 2021 time period.
Mango seed. I learned that. I love it. That's going to be my new thing. And last question on current trends. We know some sectors are hot. AI, obviously, climate's up there. Are there other sectors you're seeing picking up heat or having investor interest?
I think generative AI has taken a lot of the mind share right now. Just to give you a statistic, I listened to a few of the last Y Combinator demo day pitches. I listened to maybe like 50 pitches, and 76% of them had the word artificial intelligence in them. And so it almost is a meaningless term at this point. Everyone's just throwing into their pitch deck. I actually think that we're going to start to see a little bit of fatigue, just like we saw fatigue in Internet of Things, just like we saw fatigue in, metaverse for Web 3.0.
Got it. And anything that's especially or disproportionately fallen out of favor in terms of sectors?
I think that all the things that were really hot during COVID, a lot of investors were thinking, well, I've already made a bet in that space, I'm going to move on. So telemedicine, a lot of stuff around mental wellness. I think a lot of people are saying, like, we've done our bet there and kind of they've moved on.
Which leads us to a question of, okay, where do founders look for funding, right? Especially early stage funding. So one of the big trends, and we hear a lot about it on LinkedIn or what have you, in terms of, just this 2.2% or whatever number that goes from VC funding to women founders. What's your take on what's driving that low number? I think we've established at least some of the papers I've seen in terms of bias, but what else is out there? What else are we missing in that discourse on only 2% goes to women?
Yeah, so a lot of it is just based off of who the investors are, right? So if you look at who gets funding, the percentage is very closely aligned with who is writing the checks. So we need more diverse venture capitalists. The good news is that angel investing is now about 35-40% women. And so you are seeing much more diversity in angel checks. But unfortunately, angel checks can only get you so far. And so we need that diversity shift in the later stage rounds of investing. The other thing I will say is on the founder side, there's a lot of chatter about women founders being more capital efficient. And that is true. The data proves that very, very clearly. But it's also because women founders are raising less funding. And some of that is because they're able to raise less funding. But I find that even off the bats, they will often ask for less funding. And that makes it a little bit harder to then get to your Series A and your Series B. So I always tell women founders, especially, bump up a little bit what you're asking for. I would argue it is just as hard to raise a $2 million round as it is to raise a $3 million round.
And do you think that's hurting them disproportionately, for example, in sectors like medtech, right? Or where you need FDA approval and they come with big checks in terms of the amount of money you spend? Is that hurting them in terms of getting to the next level?
Absolutely, right? If you're looking at any industry that's very capital intensive, you have to raise enough, and you can't just raise barely enough, right? Because you need a little bit of buffer because not everything goes perfectly, as we all know.
So if you're then a woman founder looking for early stage funding, I think what comes clear is that go look for angel funding. That's obvious. I'm hearing about this post-funding gap where you get your first round from angels, but then you're not far enough along, to your point earlier about the seed stage, right? Or how much traction you should have gained. What are your thoughts? Are you seeing that? And where can founders, especially women, go to access that or address that post-funding gap?
Absolutely. So if you look at any chart that shows percentage of funding to female founders by stage, it is a very clear sharp drop as you get to later stages. The advice I give to women founders, first of all, if you think about the actual investor conversations, There's research actually out of Columbia Business School that shows that investors ask male and female founders different questions. They tend to ask male founders promotion-based questions. Tell me how you're going to become the next unicorn. And they ask female founders prevention-based questions. How are you going to prevent Google from stealing your market share? So I always tell women founders, when someone asks you a prevention-based question, answer it, and then answer the promotion-based question they didn't ask you. I also think that women founders need to not only build their network, but very intentionally leverage their network. So if I think about the emails I get on a daily basis, I get a lot more emails from women hesitantly asking me for help. Like, can I take you to coffee? I want to pick your brain. And I get many more emails from male founders saying, you know, these 3 Series D investors, can you introduce me? Here's an email that you can write to them. Boom. And so be aggressive about asking for help and really leveraging your network, and then make it really easy for people to help you.
Got it. And I take your point, and I did listen to your TED talk before, in preparation for this. I love the 3 points you made there, and I definitely make a plug to anyone listening to this to listen to your TED talk as well. I really like that. But the question there, there's a little nuance, right? I've read some research that shows that the same negotiating techniques, and I would argue that this is a negotiating technique, that I come to you and say, hey, please introduce me to Mr. or Ms. X because they're a great investor, is received differently when a woman asks for it versus when a man asks for it. Are you seeing that? And if so, how can a woman founder overcome that inherent bias, as being perceived as too aggressive, for example?
So that is true, that the same behavior done by a man and a woman can be perceived very differently. And so there are a couple pieces of advice. The first thing is, part of me just says, do it anyway, right? Because if you don't then send the emails, well, then you're definitely not going to get the introduction. So part of me says do it anyway. That said, though, if you are getting feedback that you're perceived as aggressive, pushy, there are worse words that you can be called, then what I would say is that what sometimes people talk about, like power, right? And women that are perceived as too powerful can be, called all those different words. So think about the 3 V's: verbal, vocal, and visual. Verbal is, what are the words that you're using? Vocal is, how do you sound? And then visual is, how do you look? I'm obviously speaking about spoken communication. If you are getting feedback that you're being perceived as too strong, do not dial down your strength, dial up your warmth. So dialing up your warmth tempers really a lot of strength. And so this is the reason why a lot of American presidents have dogs. It's hard to take away the power of the US president, but they dial up their warmth by giving them pets and taking photos with
Babies.
families, not holding babies. This is why politicians hold babies. And so what I would say is talk to people and think about, how can I dial up my warmth across those 3 dimensions? And that will temper what can be perceived as aggressive behavior. But then part of me says ignore it and do it anyway.
Love it. So do you have specific tactical things that women can do that demonstrates warmth while not tempering down their power?
Yeah. So one thing is replace sorry with thank you, right? So as opposed to, I'm sorry, I know you're so busy, I'm sorry to bug you, replace it with thank you for taking your time, and thank you for taking the time. I know how busy you are, right? So that can be a very small shift that both dials up your power and your worth. Looking at word choice, I do really encourage you to download Grammarly, right? And there's a free version, there's a paid version, but it will actually tell you the tone of your email. And what you can do is swap out words to dial up your warmth until Grammarly tells you things are a little bit warmer. And then, of course, you want to ask for feedback. So talk to 5 people who know you well and just lay out verbal, vocal, visual, tell them about the warmth and the power, and ask them, on a scale of 1 to 10, where am I on these 2 dimensions? What can I do to dial up my warmth, or what can I do to dial up my power? Because a lot of women need to do that as well.
Fantastic. Thanks. I love those takeaways. So shifting gears slightly, one of the things I love about your work is that you founded 37 Angels, which is an angel investing group. You're one of the co-founders. I think you've been running it for about 11 years now.
That's right.
What prompted you to start it, and what did you hope to accomplish with that effort?
Yeah, so I started angel investing in 2008. And a couple things happened to me as I was angel investing. The first thing that happened is that people kept asking me if I was lost, or asking me, where does your money come from? And all these, crazy questions. The second thing is that I kept going to events and I would write down 15 questions, and I would go home and I would Google them and I would talk to people. And I found out that a lot of the times the information didn't exist, or that even the experts didn't know about them. So I started 37 Angels with 2 goals. The first is to have more people that look like me be writing checks. That was one. And then the second thing is to shine a light on the black box that is startup investing, and really break down all these things. And it was supposed to be actually more of like an investment club with like friends, and we would just kind of get together and chat. And we very quickly realized that there was such a demand in the marketplace that people just kept wanting to take our investment boot camp to learn about this, which you can learn more about at 37angels.com/bootcamp. The funny thing, just to give you a sense of how many quote unquote experts don't know about this space, we launched our online course in, I want to say 2016. And a lot of people thought, oh, that's so smart that you're doing this. The reason why we launched the online course is not because we necessarily wanted another, channel. It's because a bunch of VCs reached out to me and said, I want to take your program because I don't understand cap table math, but I can't be seen in your program because I've been a venture capitalist for 3 years. That's why we launched the online course so that people could take the course secretly.
I love it. This is the best story I've heard, I think, a whole month, to be honest. So you've talked about what you hope to accomplish. There is more around bringing more, let's call them diverse, on the investor side. So what have been your biggest learnings and what have been your biggest surprises from an investor perspective?
My biggest learning is, I think, just like the volume of stuff I would need to do. And what I mean by that is I originally thought that we would do literally like an investment club where me and 10 girlfriends would get together, we would each bring a company, and then we would invest in one of them. And I thought that I would look at 100 deals a year and we'd invest in 5. And I just didn't realize the volume of deals that we'd have to go through. So we look at about 2,000 companies a year to invest in 10. So that was a huge surprise of just how much stuff there was out there that we had to filter through. That was a big learning. And then I think one of the biggest complaints about angel investors is that angel investors are slow. There's a lot of cat herding. And so I'm a former founder and really wanted to be incredibly efficient. And so we guarantee from pitch to funding is 4 weeks. And we run a very efficient process. And I think because of that, we have a lot of founders saying, you're the only angel network we're pitching because we are efficient and we feel like a fund, even though it is a group of about 100 individuals making decisions.
Got it. And what are you learning just in terms of the huge multiple of deals that you're seeing relative to what you expected? And especially with regard to women founders, are there themes or patterns that you can share that might be helpful to founders as they prepare their own journey?
I think that there's an assumption that people have that women tend to start companies in certain industries, right? So, fashion tech, retail, consumer packaged goods. That has been a little bit true, but I think not as true as the dialogue is out there. We have invested in lots of women that are running fintech companies or B2B SaaS companies or deep tech companies. So I think there is a little bit of truth to that, but I think not nearly as much as people think there is. That's one. And then I think that we have learned a lot about what to look for in investing in a company very quickly. Another fun fact is that the average VC looks at a pitch deck for about 3 minutes before deciding if you're going to take a meeting. So you have to get very quick at pattern recognition.
Got it. And then in terms of just the process itself, and one little data point for you, I actually had a friend who applied to 37 Angels and she said, this is the fastest response she ever got from any angel group. So clearly something that you're doing is working, if that helps. Can you just give us, for those of our listeners who don't have a clear picture, what is the process of 37 Angels and how typical is it of other similar sized angel groups?
I think the process is very similar to most groups. I think what's differentiated is the speed through which we get through our process. So our process is that a founder can apply to us off of guest, or they can just email us. And then we always look for a pitch deck, and we will very quickly look at a pitch deck to decide if we're going to take a meeting. We meet with about 1 in 4 companies that reaches out to us. And then we start with a 20 or 30-minute initial meeting. And then sometimes we'll have a second meeting to decide if there's somebody who's going to pitch. So we basically have a cycle every 2 months. We start with about 500 inbound. We meet with about 100, 125 of them. We pick 8 to pitch to our network. We write diligence memos on 3, and we usually fund about 2 out of the 8. And that process end to end takes a month.
That's pretty fast compared to what
it is. Yeah. And so our process is not abnormal in the sense that we're kind of filtering and doing more and more work as we get down to a smaller and smaller group. I just think we do it more efficiently than average.
And what allows you to cut that cycle time?
I think part of it is that we have a very clear process. We have a diligence memo template. I have to review every diligence memo. I'm an excellent cat herder. And I think it's just, frankly, the fact that we put very clear timelines, right? I think a lot of folks, if you don't put a very clear process in place, people naturally are busy and they're going to take longer than you would want them to.
Got it. And then in terms of this big fall off that happens from the pitch deck that comes in and the ones that you decide, Can you just talk about like what are the instant top 2 or 3 factors that make you decide either clear yes or clear no, and what do you do about the ones that are in between?
Yeah, so we evaluate companies using the 4P framework: people, problem, progress, and price. So, people is, of course, the team. Problem is how large is the problem? What does the competitive landscape look like? Progress is, do they have any traction? And then price is, of course, the deal terms have to be fair. And it is very much in that order of priority. In terms of people, green flags are relevant domain expertise, complementary team, and then you believe that they're going to win in the space. They have that magic light factor. Red flags would be lack of self-awareness, lack of coachability, lack of knowing who your next hires are going to need to be to really build this to scale. On the problem side, we're obviously looking for a large market with an attractive competitive landscape. I would say the biggest red flag is people not being aware of their indirect competitors. Oftentimes, founders are like, we have two direct competitors. And I'm like, maybe you have two direct competitors, but you have about 100 indirect competitors. And so, not knowing your indirect competitive landscape, I think, is a big mistake. And then progress, we are looking for a repeatable customer acquisition process. And I think sometimes founders come to us who one of their videos went viral. And I'm like, that's not a repeatable, sustainable customer acquisition process. We really want something that you can go and scale. Or they'll be like, all of my clients, they're my friends. I'm like, you probably don't have enough friends to get to a venture backable business. And so, how do you build a repeatable customer acquisition process?
And then in terms of just the type of deals again for a second, you talked about coachability, right? How do you assess that when you're just looking at a pitch deck?
I would say coachability you can't detect from a pitch deck, but coachability we will detect from the very first meeting, because oftentimes in that first meeting we will offer feedback. So I literally just I got off a pitch and I asked him, so my understanding of your competitive differentiation is X, is that right? He said, no, it's actually Y. And I said, that is not at all clear in your pitch deck. That is a great competitive differentiation. I don't get that from your pitch deck. And he took it really well and actually tested, well, what if I pitch it like this? What if I pitch it like this? What if I pitch it like this? That shows coachability. I've had that exact same conversation with a different founder, and the feedback is like, well, you just don't get it. I'm like, if I don't get it, then how is a customer going to get it by looking at a 3-second Instagram ad? So we will test it from the very first meeting whether or not they're coachable.
Before we dive back into our conversation, I want to tell you about Seed to Success. Seed to Success is our community letter with our proprietary insights on startup financial storytelling, tips, new episodes, and much more. If you find these discussions helpful in your entrepreneurial journey, use the link in the description to subscribe to Seed to Success today and get all of these and much more straight to your inbox every week. Now, back to our conversation. Got it. And then any comments in terms of the distribution of male versus female founders in your and thoughts on what you're seeing there driving
Yeah,
that?
so our deal flow is 1/3 female, 2/3 male, and that is exactly what our portfolio is as well.
Which is pretty consistent with what you're saying in terms of the overall angel landscape as well. So moving now specifically to funding for women, right? You have a lot of experience. You mentioned that you're a founder yourself, you're an angel investor. If you just had to kind of narrow down funding challenges for women, what do you think are the top 3 funding challenges women founders face?
I think the biggest problem is lack of access to network, right? At the end of the day, investors tend to invest in people that look like them. And people tend to have networks that look a lot like them. And so when the investor base is heavily male, then women are disadvantaged because they're not in those networks as much. The second thing is, of course, knowing how to leverage those networks without being perceived as pushy, aggressive, all those different things. And then I would say that the third thing, which we've also already spoken a little bit about, is access to later stage funding. I think that I don't want to say the problem isn't all solved for early stage funding, but it's at least less acute in early stage than it is in later stage.
Got it. And I'm going to just dive into that a little bit because I've spoken to a few investors and I've also spoken to a couple of academics who study this for a living. One of the pushbacks I've gotten is, well, the more professional we are as investors, the more we've been trained to not look at things like homophily bias or whatever the case, affinity bias. And what we really care about is if you come to the table with something that makes money, I don't care if you're a rabbit or a woman or what have you, we're going to invest. I'd like to hear what your thoughts are on that.
I think that for someone to say that because I know that intrinsic bias exists, that I am not falling prey to it is a very silly statement to make. At the end of the day, our brains are incredibly lazy and our brains like to put labels on people and do pattern recognition at a millisecond level. And the reason why is because when we were cavemen and cavewomen, When we saw a paw print in the snow, we have to immediately say, is that going to eat us or can we eat them? And that is hardwired into our brains. And to sort of say that because I know about, bias that I can kind of avoid it, I think it's just a very silly statement.
So in sum, I'm saying that even if you are aware of it, you cannot help but fall prey to it in some sense.
Exactly.
And kind of building on that, is there any received wisdom that's going to accept it as gospel truth about women and funding that you disagree with?
So I disagree with the fact that women investors are more risk averse. I think that is something that is often touted, and I simply disagree. And I'm sure you've seen the research that shows that women investors perform better. And I don't mean just in venture investors. I mean women hedge fund managers, right? And across most asset classes, women fund managers outperform. And then I think the idea that like women don't think big enough, that women only start lifestyle companies is also just patently untrue.
And is there anything else in the public discourse, kind of as we talk about, to your point about access to networks, kind of sector differences in terms of what investors favor, is there anything else in the public discourse that you think is worth diving into deeper or exploring more so that we can shed more light or somehow change the status quo for women so there's more of them that get access to funding?
So one thing that I think is interesting is a lot of the times we talk about the disadvantage that women don't get funding. But what's interesting is even the women who get funding are disadvantaged. And so CARTA, CARTA, they published something called the gender equity gap. We all know about the gender pay gap. But they did a really interesting study that showed that women founders also own disproportionately less of their companies than their male co-founders. And so it's not even just that women founders aren't getting funding. Even when they get that funding, they're disadvantaged compared to the male co-founders.
And this is, I'm assuming what you're talking about is, they get it a smaller check for a bigger share of the company at a lower valuation. Was the kind of the summary of what I read in that research.
Exactly. Or if they have a male co-founder, the male co-founder gets 60% and she gets 40%.
How much of that are you seeing in some of the deal flow or even the other women entrepreneurs through your teaching or anything else that you're seeing?
All the time, right? So I think something that surprises people is that, obviously as an investor, I'm constantly talking to founders about valuation. I mean, I would say probably 20% of the conversations I have are you need to increase your valuation, which might surprise people. But at the end of the day, I'm a professor before, I'm an educator before I'm an investor. And when I see somebody putting out deal terms that are going to hurt them, I will tell them. And of that 20% where I say you need to increase your valuation, 95% of those founders are women. Their valuation is too low. And that is, yes, bad for the founder, but it's also bad for the investor long term, because if by Series C, that woman founder only owns 6% of the company, she's going to be less incentivized to shoot for the moon. And I have seen women founders late stage walk away because like, this just isn't worth 4 more years of my life when the biggest upside is X, right? And they gave away too much of their company. It just simply wasn't worth it for them to continue to run it.
Got it. Tagging along or piling on that question, right? So clearly being informed about valuation is a very, very big part of negotiating a good funding deal as a founder. But if you think about it, right, where do I get the data? I need to go to PitchBook or I need to go to some other really expensive source that because I don't have access to friends in the industry or whatever, I simply don't have access to that information, right? What actionable advice or suggestions would you have for women to get a better shot at decent or fair valuations?
So yes, PitchBook and Crunchbase are very expensive from a paid resource perspective, but both of them put out a tremendous amount of free research. And they both do quarterly reports on the state of the market. So one you can look for is NVCA Venture Monitor. That is a quarterly report. But I would just subscribe to PitchBook and CB Insights daily newsletter, and then you will start getting the quarterly reports, and then you will know exactly what the venture market is looking for. On top of that, I would just make sure that you are going to demo days yourself, that you're going to pitches, you're seeing what's in the market. Have a core group of 3 to 5 investors that you're close to who know the market, where you can ask them, does this feel fair? Does this not feel fair? Talk to other founders as well, male and female, right? And so I think that these days, the data around what valuation looks like is pretty prolific and pretty available to everybody.
Coming back to sort of early stage funding drivers, right? I'm just trying to hone in on what advice you would give to women founders. If you had to pick like 3 or 4 actionable steps that you can take, I have an idea, and maybe I made progress on the product. What are the 3 or 4 actionable things I need to do that'll have, it's kind of like the 80-20 version of fundraising prep?
Yeah. So if I go to like the 4 Ps again, on the people side, I think you do need to shout from the rooftops why you're awesome. That can't be something that you're afraid of, because in early stage investing, we are primarily investing in the team. And so you do have to say why you are awesome. And if that's incredibly difficult for you, A, get some coaching, and or you can have two founders say why the other one's awesome if that feels, really uncomfortable to you. So that's on the people side. On the problem side, you need to get to a really large market size, right? So at the end of the day, angels and VCs need large exits to support their fund economics. And so you need to make us believe that this could get to, $100 million in revenue or, $500 million in revenue. And honestly, if you can't get to those numbers, it probably isn't a venture backable business and you should seek alternative forms of funding. And then on the progress side, again, we're looking for that like repeatable acquisition model. And we're looking for people who I think are willing to run a lot of experiments. This is not true of necessarily more female founders or male founders, but I often find that people tend to do customer acquisition through the channels that they know. And once one is working, they're like, okay, I'm good. I'm just going to keep doing direct email. Try like 5 different customer acquisition channels. Try influencer marketing. Try search engine optimization. There's a great book called Traction by Gabriel Weinberg, where he walks through the 19 different customer acquisition channels. Go buy that book and just make sure you're trying a few different channels because right now it is hard to get consumer eyeballs to pay attention to whatever it is that you're looking at. So you often have to try different things. And we are looking for founders who are willing to run a lot of fast failing experiments.
Got it. And then one point on, I really like what you said about you have to toot your own horn a little bit. So clearly there's stuff you're talking about in the pitch or in the conversations with the potential investor where you can bring that across. Is there something that you can do before you start your fundraising to lift up your profile? I hate to use the word personal branding, but is that effective and how should they do it if it is effective?
I think that from a like social media perspective, if you're not already, tweeting and doing all that kind of stuff, I wouldn't. Like, obviously, you need to, from a company perspective, to be active on social media to some degree. But as an individual, if you don't have a big personal brand, I personally don't think that's that big of a deal. It's not something that we spend a lot of time diligencing, but we are going to do reference checks, right? We are going to want to know, how do you handle, obstacles? Are you gritty? Have you recovered from failure in the past? Are you a good leader? Are you a good seller? All that kind of stuff. I also do really encourage people to get coaching. I hired my first vocal coach in 2008 because people's impressions are like 90% built off of how we look and how we sound and not actually off of the words that we're saying. And so I would say taking an hour on like refining the words in your pitch deck and instead spending an hour with a pitch coach where they can be like, you're speaking too quickly or you're ending your sentences with a question mark. That is very good time spent.
Got it. So one last question on the 4 Ps that you talked about in terms of preparing, right? You talked about the price and the deal terms are obviously, it's not a question of what you're buying, it's a question of what price. Women typically, at least in my experience, haven't had the exposure to understanding valuation is clearly a big piece, but then there's other pieces of the term sheet where you need to understand. So what recommendation do you have for women to get up to speed and familiar, short of hiring an expensive lawyer, which you should anyway when you're, when you're getting close to getting a check? Do you have any specific pieces of advice?
So first thing, I would give a shout out to the 37 Angels Bootcamp. A couple of additional resources for you. One is Brad Feld wrote a really good article called Term Sheet Series Wrap Up. And it's a really good overview of all the terms that matter on a kind of early stage term sheet and what each of them mean. I would start there. And then another resource for you is Cooley Go Trends. Cooley, Cooley, is a venture law firm. And they have a Tableau powered tool that tells you right now how many people are giving away liquidation preferences, how many people are giving away different terms. So the Bradfield article is like, here's what the terms mean. But then the Cooley resource tells you, and here's what the market looks like right now.
Excellent. And we'll make sure that we put those in the listening notes. Thanks for those. You talked about having some amount of sophistication and financial knowledge about all of these things. So that kind of brings us to the topic of acumen and business, financial, and strategic acumen, especially for the founder, because as you said, that's most of what you're writing the check based off of. So how important is their business, strategic, and financial acumen when you as an investor are evaluating a deal?
I don't think that everyone on the team needs to have it, right? So I think you need to have somebody on the team who is senior, who can guide you to just make smart financial decisions around, like, should you take out debt? How are you going to handle accounts payable and accounts receivables? How do you think about a smart way to manage your, revenues and expenses? How do you build a P&L report? So I do think you need to have someone on the team, but I don't think that everyone on the team has to have it. And so that's a pretty actually easy skill set to hire in. There's an organization called Early Growth Financial Services that does outsource CFO work. And so I think that it's important that someone on the team has, but not everybody needs to have it on the team.
Got it. And then when you're talking to, clearly things like market understanding and your go-to-market strategy, and is there channel conflict, and those more second order or nuanced strategic dimensions also enter into the picture when you're evaluating what they're doing. I'm just curious, either subjectively or objectively, when you're looking at a deal, how do you assess the strategic sophistication of a founder, the founding team?
Yeah, so I think what I tend to do is any number on their pitch deck or any number that they mention, I'll ask them 2 or 3 additional questions behind that number. So sometimes, like I just again looked at a pitch deck this morning and it said that they have 12% client churn, which means that 12% of their clients have left them in the last year. So my first question is, well, why have they left you? Right. And then the next question will be, well, what have you changed about your product or your onboarding process or something to reduce that churn? And then what are you planning to do going forward that you have not yet had a chance to implement? I don't know that you need like business acumen necessarily to answer those questions, but you need kind of intellectual curiosity. You need to be somebody who like wants to understand the numbers. And I find that if there's a number and I'd ask them 2 or 3 questions and the answer is kind of consistently, I don't know, or I didn't bother to check, what that shows me is like you're not looking underneath the hood of your company and you're looking at things at too surface of a level and you're not going to learn the nuances of what's really going to make this company successful.
Got it. I love that approach. So flipping that to the other side, I'm a founder and I want to get as deep as possible under the hood. What is the actionable recommendation that you'd give to make this part of like my MO, so to speak, so that I become familiar with it and I get comfortable with this process?
So the first thing I would say is just track all the numbers that you can. Like if you're doing a retail brand, like what percentage of your revenue is coming from different channels, right? What percentage of your customers are coming from different channels? Do people like your product? They just should capture all the normal metrics. And by the way, another good resource is 16 Startup Metrics. It was written by Andreessen a number of years ago, but it still very much holds up. And so I would say, if nothing else, start by tracking those 16 metrics. And then for every one of those metrics, basically ask the question, why is that number where it is? Ask, is that number good or bad? And then ask, how might I improve that number? And I would argue if you ask those 3 questions about every one of those metrics, that would be enough to be like, okay, I understand the numbers. I really understand what's driving the success or lack of success in my company.
And I hate to ask this unpopular question. Do you see a difference based on gender in terms of founders who have that grasp, don't have that grasp? Is there something we as women founders can do to improve?
I actually find that women founders know their numbers better. And the reason why is I think because women founders are held to a higher bar. There's a tremendous amount of data that shows around job promotions that women are promoted based off of performance and men are promoted based off of potential. And so I think because of that, women founders, women employees, women business leaders often have to prove themselves before they are given the chance to go do something at the next level. And I think because, we have a good reputation, we have good deal flow, I think that the founders who are pitching us, and especially if we're talking to them, they're already in that top 25% of the deals that we're looking at. I think by definition, they're going to have already proven themselves. So we actually find that the women founders that pitch us know their numbers better because they know they have to.
Got it. So what I'm taking away is, even as frankly for myself, is you kind of start with the 16 metrics and then just get in the habit of, as uncomfortable as it is, kind of getting more and more familiar and diving deeper and deeper into it. So coming back to kind of close the loop in terms of women investing in other women, I just want to delve a little bit deeper on that. So early on, you mentioned, very clearly that diversity on the investing side is really important to improve diversity on the founder side. I get that. But there's also a part of me that says, we don't need to have more women to be investing in other women, right? Like my analytical brain says, I understand the homophily bias, right? So I get that. I'm not disagreeing with that. I mean, the truth is that the majority of investment dollars are controlled by men, whether we like it or not. That's a reality. And I believe that if you're starting good ventures, whether you're a man, woman, whatever it is, you need to be able to access investment dollars, whether they're controlled by men or women. Maybe it's idealistic. The question is, what do we need to do as founders, or even at a more holistic level or systemic level, to get more mainstream investors, aka male investors, to understand the value of women-founded ventures, especially if the problem is not transparent to them?
I think it's very simply that LPs have to demand it, right? So as a venture capitalist, you raise money for limited partners, and they're how you raise your $100 million venture capital fund. And I think that you really need to push it from that angle. And what's good is that limited partners and investors and funds are starting to demand these things. They're looking for equality in the portfolio. They're also looking for things like sustainability and racial equality as well. To me, that's the greatest source of influence on a VC's behavior is their investors. And so I think that I do a lot of LP education and talking to them about why this is so important. So that's one. And I think secondly, you have to prove the case from an economic perspective. We cannot have people investing in women because it's the right thing to do or the socially conscious thing to do. You have to be doing it because it is the smart thing to do financially. And so we do know that women are more capital efficient, women exit quicker, all these things, like showing the economic case of why this is so important to do. And also, frankly, you will have a diversity of ideas that you're investing in. And that's also good because diversification works very much in this asset class. And so I think those are the two things. Really push for it on the LP side, and then really make sure that men and women understand the economic benefit of investing in a diverse portfolio.
Got it. So from an LP side, what have you found most impactful in moving the dial to say, okay, we're going to ask for this, and what actionable initiatives or efforts are you seeing as a result of that?
So a lot of the conversations I have with limited partners is here's how you should be evaluating VCs that come to you to pitch for funding. And I give them a set of questions to ask, and a bunch of them are related to diversity, right? So what is the diversity of your portfolio? What is the diversity of your deal flow? And if they don't know, it means they don't care. And I would argue half of all funds are not even tracking that. So that's kind of step one, right? So do they even track these things? And then do those numbers reflect how you want your money to be invested? And then ask them, how do they blind themselves to bias in their process? Another fun study I'll share, which I think a lot of people have probably heard at this point, is orchestras are traditionally very, very male dominated. And what they started doing is they started literally putting up a curtain between the people who were auditioning to be the orchestra and the people who were listening to them. And by doing that, they increased the number of women that got into orchestras by threefold. And then they went one step further and they said, take off your shoes. And the reason why is because when women walk across the stage, you can tell what heels sound like, and women have lighter treads. And so even that was an unconscious bias. And so by removing the shoes, then even more women got invited into the orchestra. So it's not about like teaching people about unconscious bias, but like, okay, well, now I'm not going to have it. It is very much about how do you blind your process to bias.
And I love this because I was talking to a professor, an academic, just a couple of days ago on, he had done a study that had the exact same scientific idea. This was a tech transfer research study. And he sent 50 of them to an investor with a male name for a founder and 50 of them to a female. And he said there was a significant bias in terms of not licensing the technology back to the founder or the inventor for the women relative to the men. So my question to you is, given that so much of it is based on the founder, given that so much of the investment decision rides on the personality, how do you blind the bias in this situation?
So first of all, there are funds that specifically do that. They actually will take in the kind of pitch deck and they will remove the demographic information. It is very much the minority. So I wouldn't, you can't only pitch those funds. I do know some people who they don't have the founder's photo in the pitch deck and they will do first initial, last name. I don't know that I necessarily recommend it because investors also tend to look you up on LinkedIn and you can't without a first name, but I know quite a few founders who've done that successfully. And then at the end of the day, I think that you have to, again, lean into your network because something like 80% of the deals that get done in venture capital are through a referral. So I keep going back to leverage your networks and they will help you get through that initial hump of at least getting a meeting.
Got it. And then the second lever that you mentioned in terms of diversity and getting more women funded was to make the economic case. I completely agree with you. So there's a systemic solution, which LP, whatever the case might be. The recent California law was, I think, a step in the right direction. But as an individual founder, what can I do to demonstrate that economic argument to you as an investor?
So one thing I will say is I've noticed an increasing number of outbound emails to me that say, I'm a woman founder or I'm a founder of color. And I would encourage you to not lead with that. I think that it shouldn't be the most interesting and most compelling part of your pitch. And you want to lead with the most interesting and compelling part of your pitch. Lead with strengths, lead with numbers, right? And be very direct in like, I want to pitch you. And what I would do is, again, go back to that trusted board of advisors and say, here are the like 7 bullet points I could include in the email. what are the three that are going to be the most compelling to a venture capitalist? So I think that will help you know how to put your best foot forward. And then I would say do your research as well. Investors like it when founders have done a little bit of research. So if you're able to put in your email, I think that this company is synergistic to another company in your portfolio, or I know you invest in this space, or you just said this interesting thing in TechCrunch about this space. We are very much building on that trend. I think showing that you've done your research on the investor is also helpful.
Great. And on that topic, do you have any, I hate to use the word, but hacks to make that process more efficient? Just because you have to take a multiple number of meetings, the reality as a woman founder. So each one of these research efforts takes X amount of time and you only have X hours in a day.
It is true that it takes time, but it is much better to send out 100 thoughtful emails than 200 mass emails that are going to give you a much lower kind of response rate. So I actually think that it's time well spent. It takes 3 to 6 months to raise a round. You're going to meet with probably 50 to 100 investors. That is just the reality of raising a round.
And it also speaks to me that you need to be more careful upstream in terms of kind of similar vetting process that you do with founders, do the flip side in terms of funders. Just say, if they don't make that first cut of, don't have a single woman founder in their portfolio, whatever the case might be. What are your thoughts on having that kind of a vetting process as a founder?
Unfortunately, the process to figure out what percentage of their portfolio is female, that's a pretty long process. And I don't know that that's a good use of their time.
So what would you do? What would you counsel a woman founder to do to make that, even that the pipeline processing better?
Look at the team page. Do they have a female investor? Not do they have a female person on their team, but do they have a female investor on their team? And if they do, then you should be fine.
Okay. So then is it like a tiered process where you say, I've got these 25, 30, 50 investors that I'm going to go after, and I'm going to prioritize the ones that have a female investor?
Don't know that I would necessarily do that. I think that you will unfortunately then cut off a pretty large percentage of VCs. So I don't think that you should not pitch them. I think so. So first of all, you should be reaching out to probably a couple hundred investors, not 30 to 40. But to look at a team page doesn't actually take that much time. I'll also mention one of the resources. If you go to 37angels.com/women. Actually, this is terrible. I should know that.
I have the page. Don't worry.
Oh, you do? Okay, got it. I was going to say there's it'll
be on the resource links.
And another resource for you is we have a resource on our website that's specifically for folks who only fund female founders and diverse founders.
Got it. Okay, so you've covered a lot of ground, astonishingly a lot of ground in 50 minutes. So I really appreciate the time. But I'll leave you with one thing. Is there one thing that you wish I'd asked you, but I didn't?
No, I think you've actually asked me all the questions I would have asked. I just really want to echo the point of leverage your network, ask for help, and then make it really easy for people to help you.
Fantastic. Thank you so much, Angela. This has been an amazing conversation. I really appreciate your generosity in taking the time.
Thank you so much. Great chatting with you.
And that's a wrap for today. Thank you for tuning in. If you find these conversations helpful in your own journey, please subscribe to Seed to Success, our weekly community letter with tips, insights, resources, and more. If you have any other questions relating to startup finance or financial storytelling, send them over to me at chakras@achieve.co. That's chakras@achiiv.co. We'll see you on the next episode of Invisible Ink. Now, go achieve.